Welcome, everyone, and hopefully we've gone live. We're kind of testing out the technology this time. So this is a Zoom session which we're streaming, and you can probably see beside me here is Michael. So Michael co-hosts the podcast. Hi, Michael.
Hello.
And so he's going to be kind of comparing tonight. And I just thought it would be great if we kind of did one of these together, because Michael always has some really great insights, and usually we have such a great time when we're recording the podcast that I just thought, that would be kind of infectious. So,
anyway, I think I'm meant to be asking questions from the chat, but the difficulty is I can't see the chat at the moment. So.
Really?
No, I'll try refreshing and then we'll get this show on the road. So professional. Here we go. This looks better. Have we got chat? Yes, we do. Oh, I guessed what the first question was going to be, and it is. Josie says, thoughts on what's happening with Credit Suisse? We could only start there.
Okay. So usual story, right? An hour together, and you just fire questions and we'll try and answer in a semi-entertaining fashion. Okay. So Credit Suisse, obviously today, a huge sell-off, a little bit of a rally. There was a kind of spike in the price and then it kind of fell down again. But a 30% fall in a huge bank like Credit Suisse, which is so important in Switzerland, is pretty shocking. And the credit default swaps are trading as if they're pricing in an imminent default. So
I read it was 47% chance of default within the next 12 months. That's pretty severe, isn't it? Debit Swiss.
Yeah, but even having to approach the central bank in Switzerland, that was pretty shocking. For a kind of major investment bank like that. But the thing is with Credit Suisse, I recently did a tweet which I called a tale of two Swissies, which showed UBS and a bunch of other banks and Credit Suisse, and literally it was like a fork. UBS has gone up since the pandemic and Credit Suisse has been going down. And really every single crisis that's happened, somehow Credit Suisse has been involved. And so I think
they were involved in the Archegos scandal, weren't they?
So Archegos, Greensill, and then they had the whole thing with their CEO, with hiring a private investigator. It was all. It's as if it's like a lesson in what not to do with risk. So
because I was looking at it when Silicon Valley Bank collapsed at the end of last week, and Silvergate Capital and all these banks in the US, these small ones. And then this morning I was like, not now, Credit Suisse. Last thing we need. It's down 90% in the last 2 years.
Yeah. I mean, it's pretty shocking. It's so cheap now that either it's going to be taken over, or I don't know how it's going to survive this, which is a pity, because one of my favorite reports, which is the Global Annual Returns Yearbook, which is Dimson, Marsh and Staunton. They wrote The Triumph of the Optimist, and every year they publish this thing, and it shows 120 years of returns, base rates, the whole thing. That'll go.
Ramin, when they start flogging the assets, we should bid for that unit that makes that. Get under PensionCraft.
It is.
But what I saw today was that the Saudi National Bank, who I think owns about 10% of Credit Suisse as of last year, they said, we're not going to put in any more capital. One, because they don't want to go over the 10% limit, because then they get regulated more severely. But also, I guess they just don't think they need more capital, or doubt that it's throwing good money after bad.
This is it. I mean, there's got to come a point where you just think, well, this thing's not going to make it. And, the capital's basically being thrown into a black hole.
But here's the thing. You can't argue that Credit Suisse is a globally systemically important bank, isn't it? Silicon Valley Bank is not a systemically important bank, even in the US. They declared it was after it fell apart, but it wasn't at the time. But Credit Suisse is pretty big.
But what's weird also about Credit Suisse is they've got very good capital ratios. So they do have a strong balance sheet. So how it's going to go down, I don't know. But it just seems as if people are kind of smelling blood in the water and then just assuming it's going to go, into default. But given its capital ratios, it's hard to see how that's going to happen unless they get huge capital flight, like you saw with other, like you did with Silicon Valley Bank.
But is there nasties hidden in their balance sheet that we just don't know about? So I saw they had to delay their annual report, and there was this is the accounting correct kind of question going
Well,
on.
what the auditor said, I mean, this is Price Waterhouse Coopers, they said that identified material weaknesses in its reporting controls, and that's what led to the delay. So I'm not sure that it's going to be, a kind of showstopper for the bank. I think it's just actually the processes by which they get the accounts approved.
But doesn't look good though, does it really?
It doesn't. I mean, that's what spooked people, I think. They're assuming there's something on the balance sheet which is potentially toxic.
And here's my question for you, Ramin, because you were obviously working in banking when we had the global financial crisis, 2007, 2008. What's your sixth sense saying now? Does this have the sniff of that kind of pre-Lehman, Bear Stearns environment, or is it something entirely different?
It does feel like it. And
really,
I think the worst thing is the lack of knowledge, because if they don't publish the financial reports, you don't know what's on the balance sheet. So, I mean, that's just making things much worse. So
I saw VIX got up to nearly 30 today.
I can finally sell my VIX exchange traded product.
The fund portfolio is just starting to get fun, is it?
Yeah. So I had that as a hedge. It's funny because I bought a 3 times levered S&P fund in my fund portfolio. And I thought, well, I'll buy a VIX ETF, ETN, at the same time, just in case, the S&P one goes belly up. But what happened was the S&P one went up a lot, and I kept the hedge because it never, vol never went up. So I'm left.
Sold your leveraged S&P tracker.
Oh yeah, I sold it for like a 20% gain, so that was good. But this is fund portfolio.
Held the VIX thing as we just had no volatility.
Yeah, it was just really orderly sell-off that we had last year, so it never really spiked much, or at least not enough to sell. So maybe this will be a good chance to get rid of the VIX ETN.
But people say VIX is kind of the fear gauge, don't they, in a way? So maybe we should just say, what is VIX, and at what point do you get scared when VIX, like if it's at 30 right now, I don't know exactly where. It was almost at 30 when I looked.
Let's have a look. It's one of the trackers.
But at what point would you start saying, okay, now the market's getting really scared?
Well, usually, I mean, the average of VIX is like 16, 17, something like that over the long term. Let's have a look. VIX. See if I can share my screen, see how this tech works. I'm hoping that's going to work. There we go. So this is the VIX index, and this is going back to 2004. It started being published in 1990, but SharePad only goes back to 2004. But you can see the 80% spike in 2008, and there were lots of kind of mini spikes after that. And then we had the pandemic, then it went to about 80, I think.
Yeah, it went even higher than in 2008, didn't it, for like a day?
That's right. So above 80, 85, something like that, 83.
And what is VIX? What is this magic number?
So what this does,
tells us fear.
it's based on a portfolio of out-of-the-money options for 30 days. So they're 30-day options on stocks in the S&P 500. So these are out-of-the-money options. So what this measures is implied volatility. If you wanted to buy an out-of-the-money call or an out-of-the-money put as insurance for the S&P falling or any of the stocks in it falling, that would push up the price of the derivative of the option. So this is the implied volatility of, backed out of those options prices. So it's like a giant out-of-the-money portfolio of options on stocks in the S&P 500 with 30 days to maturity.
So when it's going up, what is it telling us?
That the market's scared. So you're paying more for the protection in case the stock market's going to tank, or paying more for the upside. You can also have up crashes, in which case that also pushes up volatility.
That would be nice, wouldn't it?
It has happened, it has happened in the past. But let's have a look at today. So, right. So if we compare that with the spike in 2020, you can see it's not even on the map. It's not even on the radar. So at the moment, things are still pretty calm for the markets overall. And if you look at the S&P, so if we look at SPY, the big S&P tracker today, it hasn't hasn't absolutely tanked today. It hasn't been a good day, clearly. A lot of volume.
It's been an interesting day, though. I think oil is down like 5%.
Yeah, that was interesting because, that's different, right? Because that's usually a kind of macroeconomic growth thing. So I'm surprised that oil is probably more to do with supply there. Let's have a look at WTI. So yeah, pretty chunky move. Oh yeah.
Is it people saying we're going to get a recession and a fall in demand?
Yeah, I mean, that's the thinking behind it.
Because yields are also falling, aren't they? 2-year yields in the US are way down.
Yeah. So this thing down, oh God, that's massive.
Did you not know about this stuff? I just like broken the news to you.
No, the oil thing I'd seen that in the FT today, along with the along with the Credit Suisse thing, obviously, because I've been recording a video about the budget in the UK.
You're going to have to start live streaming pretty much every day soon if VIX keeps going up.
It's funny though, people have a huge appetite for these things when there's a crisis, but yeah. So where's the oil thing? Oil. Here we go. Okay, this was the other thing I saw. So the IEA said that there was a surge in rich country oil stockpiles, suggesting supply was overwhelming tepid global demand. So it could be a supply thing.
Not a great day for Saudi Arabia then, if their oil price is way down and their Credit Suisse stock holding is way down.
Oh dear. So let's have a look at Exxon. I mean, all of these kind of energy majors have also suffered a lot, obviously. So those were the kind of stars of 2022, really the only place to hide. But you can see that there's been a pretty brutal sell-off there as well. So that kind of peaked. When was that? That was February the 10th. And since then, it's down 14%, Exxon. So that energy trade is pretty much over. I've had a look at it.
Yeah, energy you don't want to be in right now, it looks like. And also financials are getting battered across Europe and America.
But the other thing I did today is I published I do a kind of momentum portfolio, which is always interesting because what I find useful about this, let me just see if I can find the tweet, is it kind of monitors what's going on with momentum. So it's got a 180-day look back period. And I publish it every month. Now I do it on Twitter. I used to do videos on it. And the idea is it's got 5 different asset classes. So it's got global equity from each different country, US sectors, US factors, bonds and commodities. And then you get one winner from each asset type that has the biggest momentum, makes it through into the portfolio. And if nothing goes up, then you're in cash.
Sometimes it gives really weird answers. Like it keeps telling us to buy Turkish equity, Ramin, which you have to be brave to do.
But Turkish equity's done so well.
I know it has, but it's still scary.
Oh, and guess what? What did best last week? It was, it outperformed the S&P again, Turkish equity. So that was a good call. But what's interesting is recently, if you look at the factors, here we go, factors. Over the last 180 days, there's been a switch to mid caps. So last month it was mid cap value. So, and now it's switched to mid cap growth for this month. So it seems like mid caps are the place to be. But
value is going to be hurt, I think, by financials doing so poorly, right?
Yeah, because they were value for a while, but so was energy before the big rally. Yeah, But it's interesting that.
Are we at a turning point then?
Well, I think that's pretty clear. The momentum has been shifting really dramatically, and it shows up in the portfolio. So that's why I thought that would be interesting to share. Anyway, yeah.
Right. I feel like I should ask some questions from the audience.
Yeah, go on.
G Tor, who is a PensionCraft member, and we're going to answer this question first. He says, "Hi, Ramin. Last week you discussed merit in tilting against the US with a possible lost decade ahead. FTSE Developed Europe took a hit today, down nearly 4%. What do you think of buying this dip?"
Well, look, for the core portfolio, I wouldn't stop buying. This kind of thing just increases your long-term return. So core portfolio, ignore the news, just keep buying. and just stick with it. That's usually the best thing to do. If you're going to do tactical stuff in a fund portfolio kind of context, then the point about the lost decade was it is a long-term effect that I was talking about, because Vanguard publishes these 10-year outlooks. And I should also say it's not my view, it's Vanguard's view, but I think it's a reasonable view, which is that if the dollar's strong compared to purchasing power parity or their own model, which it is, then over the next decade, you would expect it to devalue gradually over time, or maybe quickly over time. And then you've also got the valuation argument, which is the US is just so much more expensive than everywhere else. And that logic is hard to defy. When the US has been very expensive in the past, usually that is a kind of prelude to US underperformance. So I think
here's
the
a
argument,
question then. If we sometimes say, something looks cheap and it's cheap for a reason, with the US, could we say it's expensive, but it's expensive for a reason?
Yeah, I think it is expensive for a reason. And I think it's because people have, the memory of the previous decade. I think this is a kind of recency bias. And because, the US was the only show in town, really, over the last decade or so. And, that hasn't really changed so far. But that's exactly why it's overpriced, right? Because it has outperformed so much relative to every other country for so long. And people probably don't even remember a lost decade for the US. It was so long ago. The last time this happened was around 2000. And I just remember the despair in 2003 when everyone was just saying, I don't want to buy stocks. You'd have to be crazy. Will things ever improve? But, they did. But the US underperformed for a decade after that, after the dot-com bubble burst. So, it happens. And it's after one of these euphoric phases, usually. But in terms of safety, and I guess that's what the question's about, then the US is still the biggest safe haven. It's the biggest economy in the world. It's got the biggest bond market, biggest equity market by far, the deepest capital markets, the biggest central bank with the biggest firepower, and just
they're prepared to use it.
Yeah, and they're always acting in their own interests. Of course they do. Any country would. So, yeah, in these kind of crisis periods, I probably favor the US over Europe.
Yeah.
But, use these opportunities, because I think we may be entering a period when there's a lot of opportunities.
Isn't it also quite hard to get a big US crisis without it affecting all the other markets in the world?
Oh, yeah. I mean, it's like US and China. It's like mum and dad. If mum argues and dad argues, either of them
they do argue a lot, those two.
Yeah, there's been a difficulty in the marriage recently, that's for sure. But either one would kind of bring down global markets now. It used to just be the US that was kind of prime player and everything. But of course, now China's just as important, I'd say.
Okay, so a question from Roger P, who says, how are money market funds impacted by this turmoil at the moment?
Well, let's have a look. It depends on the type of money market, obviously. Let's have a look at the one I've been talking about a lot recently, which tracks Sonia, which isn't a pop band or anything like that.
We wouldn't know.
Is there a group called
Popular Music now?
You'd know that, wouldn't you? You'd know if there's
No. I'll only get back into music when my daughter gets to her teenage years, I think.
Right. So this is what CSH2 looks like. And has there been an effect? No. It just keeps going up.
If yields fall, though, surely its income will.
Its income falls. So what happens is the curve flattens out. Now, the one thing which was worrying was this blip. Oh, look. It doesn't just go up. Now that was the March 2020, when we had the big pandemic sell-off, and then the Fed saved the day. But
March 2020 ruined all the graphs, didn't it? So many just go off the scale. Money market funds with these notches in them.
Yeah. But here as well, you can see there was a bit of a notch. So for this kind of money market fund, which tracks a cash benchmark, in this case for the sterling overnight index average, SONIA, this one won't be affected by a sell-off because the short end of the yield curve is still pretty high and it's going to stay there. Now, if this starts to become a problem like March 2020, then yeah, the central banks will cut, and this thing's yield is going to go down sharpish really quickly. It responds really quickly. How about if we look at an ultra short money market fund? So this thing is not a money market fund, but it's ultra short duration. And can I find it? Yeah, this one. So this is an ultra short money market fund. Now you can tell that this thing does have a price that goes down because this thing does have duration, very short duration, which is why these fluctuations, although they look huge, if you look at the axis, you see it's 101 here and 99.6. So
if
the
you
actual
work in media, you've always got to get the axis right to make it look like this, whatever the graph is.
Yeah, let's overlay
the sharp balls.
So let's add something like the S&P 500 SPY, just for context, right? Just so we can see.
It's going to look like a flat line now, isn't it?
Ooh, yeah. So that's basically a flat line. So the original graph for the ultra short money market fund is here, and this is the S&P. So that just puts it in context how volatile it is. It's not. But it will be affected. Again, this thing's going to pick up short-term interest rates. Because if we look at what it owns, a lot of these will be very short duration. So the maturity range, because it's money market type instruments, about 12% of it is between 183 and 364 days. So 6 months to a year maturity. And then 1 to 3 years makes up another 8%. And then 91 to 182 2 days, 5.5. So really short duration stuff. So money market funds are fine, in summary.
Yeah. It's very much a horizontal line. If you want to see a vertical line, look at the credit default swaps for Credit Suisse today.
Which I don't know.
Fully vertical.
It might be on Bloomberg. I got it on Bloomberg. Yeah, that was the budget. Bloomberg.com. Here we go. Credit Suisse. Has it got the credit default swaps?
I mean, it's just a vertical line.
Yeah,
imagine that.
Interesting. Has it got credit default swaps? If I spell it right, it might. Nope. Back to here. Where's the Credit Suisse story? Here we go. Here we go, CDS. So if you're not familiar with CDS, I used to work on CDS, funnily enough, in the investment banking world.
In the global financial crisis?
Yes.
Oh, man.
And it's so funny because I remember there were CDS on investment banks in 2006, and they used to have spreads, which is the compensation for the default or premium if you're buying insurance against default, of 5 basis points. And I thought, well, why bother with this? I mean, they're never going to default. And that was 2006. My view changed very quickly in 2009. Yeah. But if you look at Credit Suisse right now, there's a whole term structure of the CDS. So if you want to protect for the next year, let's say you've got a one-year bond issued by Credit Suisse, and you want to buy insurance which pays out if they default, then and it's a 1-year bond, you buy one of these CDS. Now, when things go really freaky, they start trading at, like thousands of basis points, which is exactly what's happening right now. So over the course of 5 days, the 1-year CDS has gone from 356 basis points, which is pretty high for an investment grade financial, which it wasn't.
It's not cheap, is it, to insure against Credit Suisse?
Now it's 2,850 basis points. So that's pretty high.
So
You
it's
can
just saying it's
actually,
a coin toss then if it's going to survive for the next year.
there's an equation you can use for it actually to work out what the probability of default is. So it's a spread over 1 minus the recovery rate. So if the spread is what? 28.
Just showing off now, Ramin. No one wants to see you do this.
So 0.2851 over 1 minus the recovery rate. So let's say the recovery rate's 40%. So that's a probability of default of about 50%.
Yeah.
Just under 50%. Whereas
There
last
must
week,
be a solution being worked on. Either it's going to have to be bailed out and nationalized, it's going to have to be merged with UBS, or they're going to have to find some capital from somewhere, right? They got to shore it up.
yeah, I mean, you can't have such an important bank potentially going bust. It's just certainly for Switzerland, it's such an important bank because if it was going to be absorbed into UBS, then there'd just be one mega bank in the whole country. If anything, that's going to increase the risk to the country as a whole because suddenly it becomes.
It just seems unforeseeable. Like it would be like merging Man United and Man City, though, right? You wouldn't put them in the same room.
I've got no idea, Michael.
No, sorry. Laura's telling us we should tell people to like this stream. I'm not a YouTuber, so what do you usually say? Don't you usually say smash that like button or something, Ramin? Is that what you say?
Yeah, right. Please like, share, even if you're watching it in playback, because some people watch this. In fact, a lot of people watch this in a replay. So yeah, please do share. Please do like it because it helps us a lot. And
subscribe to the podcast. Many happy returns.
Yes, it's so funny. I did an ad for the podcast in one of the previous videos, and I was recording it in a hurry, and I forgot to give the name.
Yeah, if I'd been paying for that ad, I would have asked for a refund. All right, another member question from Alex W. He says, "Hi, Ramin and Michael. The big threat seems to be government bond losses at the long end. That's of the yield curve, I presume. Shouldn't big institutions have a pretty good quality interest rate hedge? What am I missing? Thanks for the content." So why aren't they hedging? Well, why hadn't Silicon Valley Bank hedged their duration risk?
I think they did hedge for a while. So what you normally do is if you've got bonds which are paying you a coupon, right? So you're receiving a fixed interest payment. What you do is you enter a swap and you receive those fixed and then you pay those fixed away to the counterparty and you receive floating. So it's kind of like alchemy. You can take a fixed rate bond and convert it into a floating rate bond. And floating rate bonds have almost no duration. So interest rates can move up and down, you don't care. So the point about the risk is that somebody else is going to take it and it's not going to be you. So
someone
that's how
has to take that interest rate risk somewhere, right? And you have to find a counterparty who's willing to take that bet at an affordable price.
Yeah. But these things are usually margined on a daily basis or a weekly basis. There'll be some kind of reset frequency. So the mark-to-market losses and gains can't get too big because you don't want to actually create counterparty risk with these things.
The thing is, the banks, though, with these hold-to-maturity securities, if you're into the nuances of this stuff, are not getting mark-to-market, which was kind of the problem, right? So there were huge mark-to-market losses, and without interest rate swaps in place.
And there still are. If these assets are held to maturity, so when you say this asset, this bond that I hold, this treasury, this 30-year treasury is held to maturity, you don't have to declare it on the main income statement. So that's a real, so it's kind of like a time bomb that hasn't gone off. But the minute you get outflows is when you have to sell these things, crystallize the loss, and then, the bomb kind of goes off.
Because everyone was saying in the build-up over the last year, when rates were going up and people getting scared, they were saying bank balance sheets are healthy, way more healthy than they were in 2007. But was that all a mirage? Is it just that we weren't marking their assets to market?
Well, look, normally having treasuries on the balance sheet is a good thing. They've got zero risk weight. They They can be used as collateral with the Fed, and now they can be used as collateral with the Fed priced at par. So I've got this bond which is worth 70 cents, and you give it to the Fed, and magically you get balance sheet money laundering, or risk laundering, we should call it.
Yeah, I mean, they're paying interest rate for it, right? The money they get. I think they're paying like Fed funds plus 10 basis points, but it's still pricing it at par is a big change.
Yeah, I mean, that's pretty shocking. But that kind of risk laundering using the Fed's balance sheet is just incredibly powerful. And it means that now I don't think a lot of these institutions can go wrong, because if you do have these depressed assets, you just hand them to the Fed and get cash.
Is it QE by any other name? Are we saying these banks with, long-term bonds at 70 cents on the dollar, hand them to the Fed, get 100 back? That's QE, right? Sort of.
Yeah, and the Fed's balance sheet is going to grow again. So I think that'll be interesting, to see how much it grows, because I think they've limited the size of the scheme. I think it was something like 60 billion. I can't remember off the top of my head, but we'll just see what the uptake is.
It's one of those things where I just can't predict. I mean, I can't predict anything anyway, because I don't know anything. But it seems like no one can predict what the effect's going to be of this, because it's so new.
And every one of these crises, you just lurch from one new situation to the next, like QE and what the Bank of Japan was doing, which is much bigger than what everyone else is doing in terms of QE, QQE they call it. Everything is new, and so every crisis we're just kind of jumping to new monetary policy tools. And I just think at a certain point they're going to run out of ways of kind of dodging these bullets. But anyway, we're a long way off that right now. I think that this isn't going to be.
I don't know if we're this way. I don't know if we're so far off it, because inflation might constrain them, right? If inflation keeps running hot, can you keep printing money? Can you keep jacking up interest rates, which are then going to kill the banks, right? They can't be boxed in.
I mean, they do have flexibility in terms of, the balance sheet is one tool. Another one is interest rates, obviously, and that one they can't use at the moment because they're using that to fight inflation. So, they are constrained in some ways, but they've got so many tools they can use, and they just used two so far. And they've got multiple plans, I think, for these kind of eventualities.
Yeah.
We'll just have to see what they come up with next. But this was a good one. I mean, it was fairly, after 2008, this is a fairly standard response, I
think you predicted it on Twitter, more or less exactly what
I did, yeah. That was lucky, wasn't
it? Yeah. You're still angling for that job at the Fed.
Oh, yeah, I'm fighting Mohammed El Arian for it, yeah.
Okay, here's a super chat from Amir Katabchi, who says, with markets in this state, should I do dollar cost averaging or lump sum into my ISA after the start of the tax year? And he says, why no podcast drop today? Well, because we put it out early on Monday, because it would all have been out of date by the time we got to today. Everyone should go and listen to though. It's about the Silicon Valley Bank collapse. So yeah, dollar cost averaging or lump sum when we get to April?
I think at the moment, things are getting choppy again. So if I had a lump sum, probably I'd be dollar cost averaging now. Probably over the next.
The answer is lump sum, by the way, because I think the reason you dollar cost average, dollar cost averaging underperforms, doesn't it? 2/3 of the time.
That's right.
That's what Vanguard study said. And I think if you're going to be invested for the long term, you kind of just need to suck it up, right? And get used to the fact that markets are unpredictable. And if you don't reconcile yourself to that fact, you're always going to lose. So you just need to reconcile yourself to that at the start, is my view. And just
if
you're your teeth and go for it.
It's because you've got a higher risk appetite than me. I'm quite nervous. So if I put the money in and it crashed like 50% next week, and there was a kind of systemic problem that the Fed couldn't solve and central banks couldn't solve, then I'd feel awful, terrible.
That's what your fund portfolio is for, isn't it? Losing 50% the week after.
Right. Oh yeah, I just bought some bonds. I just did a bond ladder thing.
Really?
Use my ISA limit, and I bought an inflation.
The idea of that?
So this was just to show people how to do it, because it's one thing to talk about the theory, But the actual practice is so much more helpful, I think, because I mean, all the little things, right? So if I didn't know what I was doing, the government bond, it was with Interactive Investor. The government bond, I just could buy online, right? So I just said, I want £5,000 worth of this bond. This is the ticker. Thank you very much. And that was it. It was just traded. The inflation linked bond, it said, this has to be traded on the phone. So I recorded myself for the YouTube, for the PensionCraft community.
Oh, I need to listen to this.
This is the explainer. And I recorded the phone call with this really nice lady, and I got the music,
Did you tell her you were recording this?
Yeah, at the end.
Okay,
I said, you're famous.
You're going to get done for like wire fraud.
Well, they record our phone calls, so I don't see why I couldn't. But anyway, so I recorded it. But what was interesting is things like the clean price for a linker and the dirty price was including the inflation uplift. So that was worth £1.48. But then the clean price was like 99 pence. And then it kept switching between values of 100 and values of £1. And that would confuse people. So all the little things like working out the yield from the price, explaining that for a linker, you don't know what you're going to get because there's this 3-month lag for the RPI index. And so all of this stuff, which normally you wouldn't think about if you're kind of used to it. I just thought I'd show people because, then you don't get flummoxed. And you get, and then she was throwing all these numbers at me and I was just listening for the word dirty price. And it was 148. And I thought, yeah, that's right.
You can't say that to a call center worker though. Can you just say dirty price for me? You get into all sorts of trouble. Right. We've got another question. This is from Lenin Velaturi, who's a PensionCraft member. Where to look for bargains now? It looks like Christmas is around the corner. So where is the bargains, Ramin? They're coming, right?
Well, let's have a look at high yield.
Yeah, I was going to say, don't you dare tell me the FTSE.
High yield. Let's have a look at high yield. And let's look at the spreads. Where can I find that? I know a good one. We can look at HYG. So let's just look at one of the ETFs. HYG. Am I sharing my screen? Can you see this, Michael?
Yeah.
Okay. So this is a big junk bond fund in the US. I'll get rid of the S&P. Switch that off. And have a look. So this thing has sold off quite a bit. So today it's sold off probably a bit more. But this kind of is correlated with equity because high yield is low down in the capital structure. So because it's low credit quality, it tends to be highly correlated with equity.
When you say it's low down in the capital structure, what do you mean? You're more likely to lose your money in a bankruptcy.
Yeah. But actually, that's not strictly true. I mean, it just has a low credit rating. It could be high in the capital structure for that company. But capital structure is just the idea that if a company goes bankrupt, the equity gets wiped out completely. You lose everything. And then you've got your kind of junior bonds. They get mostly wiped out. Then you get the senior bonds. Then you get the senior secured bonds, which have assets put aside for them. And there you lose nothing or almost nothing.
Even if the top comes the tax man.
Yeah. But this thing, I mean, it's sold off quite a bit. So, but let's look at the spreads because that's kind of interesting. So let's have a look on Fred, high yield spreads. So this is the option adjusted high yield spread in the US. Oh, it has picked up a bit. Look at that.
What are we at now?
So this was on the 30th, that was 2 days ago, and then it fell again on the 14th, so 4.74. Now, a recession, usually you get to about 7% on this thing. Let's go back to the maximum period. Yeah, so if we go back to 2020, we got to about what? About 8.77. So we're not pricing in a recession right now. We're not even where we were in 2022. So yeah, I think at the moment, still not attractive, but it's moving in the right direction. But if this got to about 7, I'd definitely be interested in high yield. Now let's have a look at something else. Let's look at Yardeni. Oh, we don't want that. Yardeni. Whoops, who's that guy? Yardeni forward PE. And let's look for S&P small cap. There we go. So let's look for US large caps, mid caps, and small caps just to see where we stand. So it's still pretty much the same. This is as of, when was this? This was March the 15th, so that was today. And the S&P, still kind of average expensiveness, you know, not cheap, not expensive compared to history going back to 99. And this is the price divided by the forward 1 year estimated profits. And mid caps, all those looking quite cheap, you know, not very. The small caps, yeah, those looking pretty tasty, 13.1. And if we go
You
back
said
to
in your momentum portfolio, it's going for mid cap growth, was it now?
Yeah, mid cap growth. So, you know, that is looking quite cheap, as well as having momentum, good combo. Small caps have sold off because I've got a small cap ETF which buys the S&P 600. It's an S&P 600 tracker. So yeah, that one's still looking cheap.
Is that because of domestic and regional banks in there? Why is it selling off?
I don't know. Let's have a look at the composition because that could be interesting. S&P 600 should be a fact sheet for it. ETF. If I can find one for my shares, yeah, perfect. So this is great for drilling into the contents of an index. You find an ETF which is managed by iShares, and their website's just awesome. And they show you the holdings. Here we go. So financials make up 16%, and industrials are the biggie. And industrials have been doing pretty well recently. So that's the
financials element would make me slightly worried.
Yeah, 16% is chunky, but look,
that's the small banks, right, who are likely to experience deposit flight.
Yeah, you're right. You're right. It'll be the regional banks which are in there. So see if we can find one. So shout if you see some.
They're not going to be high up because they're like small in relative terms, but there's loads of them.
Let's have a look at page 3. No.
I see one. Or
Where
I see
is
a financial assured guarantee limited. I don't know what it is, but there are going to be some in there.
Yeah, but you know, 16% I could kind of live with. I could kind of live with that. High quality. Oh gosh, yes, assured guarantee. They provide kind of insurance.
But if we do get a bit of trouble, a downturn, a recession, or you know, a credit crunch, surely that hurts small companies usually.
Oh yeah, I mean, what's going to happen in a downturn is small caps sell off. But you know, again, the time when you buy this stuff is during a crisis. So that was the question, I think. So it's going to get cheaper, probably, if this thing gets worse. But even if it doesn't, you're buying it at a pretty cheap price right now. So that's the way I'd look at it. You know, if you are going to catch a falling knife, then just be reassured that it is going to recover. So small caps looking cheap. US as a whole, not. Credit, not looking cheap at the moment.
If you're a gambler and want to toss a coin, then some of the European banks.
Yeah, I mean, like XLF. So let's have a look at XLF. That's probably sold off a lot. XLF. So this is a US financial select sector spider fund. Oh, yeah. And the one that Eric Balchunas has been talking about, the ETF guy from Bloomberg, is KRE, which is regional banks, I think. So I bet that's really hurting. So let's just see how much this financials one's down. think it'll be pretty chunky. So if you're brave, yeah, contrarians would be buying this right now, down 14%. And the other one is KRE. I hope I remember the ticker right. We have to interview Eric Balchunas. He's just written a book.
What's the book?
Can't remember. It's about I think it's about Jack Bogle.
Oh, really?
Yeah.
You interviewed his nephew the other day.
That's right. Yeah. The community, that was really good. Here we go. So let's see the size of the fall. That is falling like a stone, isn't it?
Yeah.
27, 30% fall. Look at the volume, a hell of a lot of volume traded.
Do you remember when everyone was saying higher interest rates were going to be good for banks? Was only a few months ago. Oh, net interest margin is going up.
Yeah.
Never listen to the analysts. Okay, anyway. I've got a question. I think we got all through the members' questions, but Timwood 101 says, prediction on Fed rate hike changes, please. Because I believe that the market is quickly repricing the chances of a hike at the next meeting, and also is, I think, forecasting quite a few rate cuts by the end of the year now. And if that does come to pass, bonds look decent, right? Because if yields fall, then the prices are going up.
That's right. So next meeting in 6 days, and the current rate for Fed funds is between 450 and 475. If we look at the probabilities, oh my God. I hadn't seen this.
Oh yeah, later in the year, they're all pricing in cuts now, Ramin. I told you it's coming. I told you the pivot's
away
coming.
For 5 minutes and the whole market changes. I can't believe it. So we're currently here. What they're forecasting now is, it's very dispersed.
Yeah.
So, 6 days' time, most likely is a 25 basis point hike.
I think they have to hike. I think there's nothing in the inflation numbers to say they should stop, right? So if they stop, it shows that they're scared of the banks.
Yeah, they'll lose credibility when it comes to fighting inflation if they cut now. So I think they're using their balance sheet to deal with the crisis, and they're using rates to deal with inflation. That seems to be their kind of approach. Different tools for different goals.
Look at that number though for the end of 2023. It says we're going to be cut 50 basis points from where we will be after the next meeting, at least, maybe more actually.
Yeah. So
if that proved to be true, and you bought bonds now, you would be in a good position, right?
The short-term ones, because remember the short end of the curve is what would move down. So that kind of ultra-short money market fund that we saw, that'll go up a tiny bit. But the mark-to-market gains for the short end of the curve aren't very big anyway.
Lever it up, Ramin.
But what I'd be thinking is, I'd probably go further out on the curve, because if you think rates are going down, then you'd extend duration. So what I've done is I've bought long duration bonds, US Treasuries, in my fund portfolio. I did it a while ago because I thought growth would disappoint, and I thought inflation would come down faster than people expected. So I got the right trade for the wrong reasons, which is a result, right?
Yes, kind of strategist, isn't it?
What I then have to do is retroactively say that's what I meant all along. Unfortunately, everything I do is documented, so I can't do that. But this is pretty shocking.
Do you buy this though? Do you think this is a hell of a turnaround, right? So before
this is not going to happen, I don't think.
So before the bank blow-ups at the end of last week, it was pricing in a 50 basis point rise for this meeting in March, and it was forecasting we're going up to almost 6%.
Yeah, but that's now gone to zero. So anything above 500 is now at a probability of zero unless it's May.
Goldman Sachs is predicting no hikes anymore. Like they reckon rates have peaked.
I think they've got the wrong end of the stick. I think that what's going to happen if PCE inflation is so hot, then you can't ignore that if you're the Fed. So if we look at the year-on-year change on PCE inflation, yeah, if inflation and where's his headline? Headline inflation is what, 5.4? That's twice the Fed's target. There's no way they're going to cut.
The thing about core services inflation, which is what's driving, or it's what's driven by wages, that's actually accelerating over the last month. So it's 0.3, 0.3, 0.4, now 0.5 on a month-to-month basis. So
I was complaining to Fred that they don't have Jerome's favorite, what is it, services excluding domestic services? Yeah.
That was the one that I think would scare the Fed, because that is self-sustaining, right? Wages. You talk about it was originally driven by oil and microchip shortages and supply chains. We're way beyond that now. It's being driven by the potential of a wage price spiral.
Yeah.
It's not there, but it's got the potential, right? With such a tight labor market.
Yeah, and it's 4.7 on core, and it's not really going down. It kind of ticked upwards last time.
How would you read it if they don't raise rates at the next meeting? Would you then think, okay, we've peaked?
Well, it's always data dependent. I mean, it could always, if we get a second peak with inflation, they've just got to do something about it. But yeah, I mean, you could say that's the end of the cycle. People say, they hike until something breaks, and this is broken, so that's the end of it. But I don't think that's true.
I think they'll hike. If I had to guess right now, unless something massive happens, I think they'll hike.
I mean, this is what we said on the podcast, right? Which is that inflation affects everybody, from the busboy at the restaurant up to the CEO of a multinational. Whereas, this kind of banking crisis is a very financially type thing, which affects Wall Street, but not Main Street. But inflation just destroys livelihoods across the entire economy. It lays waste to the buying power of money. So I just think that's a much bigger priority for the Fed.
If they did cut rates in line with what the market expects over the next 12 months, would that be bullish for growth stocks, or are we beyond that now?
If they cut rates?
If they do what that we just looked on that prediction, where it was like a 1% rate cut by the rest of the year.
Well, it depends why they're cutting, right? If it was about a crisis, then, not so good for growth stocks. If it was because they felt core inflation was starting to finally show those signs of falling, then that would be great for growth stocks. But at the moment, growth is getting battered.
Yeah.
Let's have a look at ARK. That's my favorite.
Thought we were going to get through this whole hour without Kathy.
Never. Okay, what should we have? ARK, okay. There was a story in the FT recently about how much she's making in terms of fees. It's just been unbelievable, even during this down period.
I thought she always looked pretty sprightly when I saw her interviewed.
So, not too bad. In fact, it's up over the last month or so. Clearly not over the last year. So how much is it down now? It's down in total, down 76% from the peak in 2021. And she's still, raking in the money. Incredible.
Okay, here's something we haven't talked about. Bob is asking about the budget today in the UK and the removal of the lifetime allowance around UK pensions. For a channel called PensionCraft, Ramin, we've taken a long time to get to this massive pensions news.
I just recorded a video about it, so I just never want to talk about it ever again. But yeah, go on.
Okay, so what happened today? What was announced?
So it was shocking, absolutely shocking. I've got the speech here.
What speech is this?
This is so this is the Chancellor's speech. So this is Hunt's speech. Lifetime. Here we go. Let me share my screen so you can see. So he was talking about doctors and the fact that they get whacked with a tax increase because they earn so much money. they're on this kind of cusp of going up one level. And he says no one should be pushed out of the workforce for tax reasons. So today I'll increase the pensions allowance, tax-free allowance, by 50% from 40k to 60k. So every year you can put now 60k into your SIP.
That wasn't the bombshell though. What was the bombshell?
Yeah, some have also asked me to increase the lifetime allowance from its 1 million limit. But I've decided not to do that. And I thought, oh my God, I can't believe he's not going to do that. And then he said, instead, I'll go further and abolish the lifetime allowance altogether.
Those doctors have had a big win for everyone, right? It was all for the doctors, guys.
It's a small proportion of people who've got this problem, which is that, they've got more than 1 million. Quite a few people I speak to, I have to say. So for them, it's
am I allowed to give a view here? I think it was bad policy, right? The lifetime allowance, because it's so dependent on market returns and you can't predict that over a lifetime. Is your final pot going to be at a certain level? But I don't really get the logic on the 40 to 60 on the annual basis. But
look,
it's good.
The second reason he gives is to incentivize our most experienced and productive workers, old people like me, to stay in work for longer. So you're going to think, well, I've got a cushy retirement. I live in the south of France. I go to the boulangerie in the morning and then I kind of walk my dog. This is like heaven. You're going to think, well, I'd really like to go back to commuting into the city and having people shout at me. I don't think many people are going to buy that because my pension pot could get even bigger.
I don't think it'll entice people who have retired back into the workforce, but maybe it'll prolong people's careers who are already working. If you think you can earn a bit more, maybe.
I mean, the big deal is the number of people who've left the workforce. That's shocking. And, there was a nice article from Paul Johnson from the Institute for Fiscal Studies where he was talking about the people who've left, the 50 and 60 somethings like me. And he says it's for two reasons. One of them is bad health. Not much you can do about that. And the second thing was to do with having enough money. They've just got enough. And once you've reached enough.
Yeah, this will help people get to enough quicker. So what I would actually expect is this will be negative for people staying in the workforce. So what I think they will do, the next thing next year is they'll increase the age where you can get the personal pension. That'll go up, I reckon. But what they have done is they've frozen the 25% lump sum at what was the 25% of the previous £1 million cap, haven't they?
So instead of 55, maybe make it 60, and then you have to stay in the workforce longer.
Well, it's 57 now, or going to be 57. I think,
57, yeah. And so increase it to 60.
Yeah, it's a trade-off, isn't it? I mean, I saw that also the other thing keeping people out of the workforce is the childcare costs, right? And I saw that they've introduced they will be introducing 30 hours of free childcare for children under 3, which I thought brilliant. And I looked at the date just as my daughter turns 3. It's like, oh no, I've missed out.
Where was it? So there was a nice thing that was out. See if I can find the document. But what I was looking for, if you look at the actual forecast from the OBS, see if I can find the document. Yeah, I've got the document. Look at the forecast for growth. Actually, I could just share one of my slides from the Prezzo. Just talk to people, Michael, while I scoot through.
Talk to them. Subscribe to Many Happy Returns. That's why I'm here, to plug the podcast.
Okay.
On Apple, right. Spotify, Google, wherever else podcasts exist.
Very good.
It's good fun every week on a Wednesday, except this week.
Here we go. So this is the growth forecast from the OBR, the Office of Budget Responsibility. And so the forecast from November is yellow. The forecast today is in green. Is that right? Are those the right colours?
I'm also colourblind, so
okay.
I'm not going to get very far here.
Anyway, so, what's good is that the recession that the OBR was forecasting is not going to happen. It's just going to be a smaller recession, a 0.2% fall in activity, GDP.
They've actually said it's technically not going to be a recession because it's not concurrent quarters.
Yeah.
It's just spiky enough to get past it and go, oh, there's no recession.
Just.
Yeah.
And then next year, another 0.5 percentage points higher. Yeah. But look, what year is the election going to be, Michael?
2025, I believe.
Oh, look. And that's the turning point when GDP gets
Are you
lower.
suggesting there's influence on the GDP numbers from the government?
I didn't say that. I didn't say.
The OBR are fighting for their independence.
Or you
I wonder
could
what the
say,
logic is for that, though, to be honest.
Well, I think the way it works is all of the stimulus programs, like that tax rebate for companies, where if they spend on capital, if they spend on infrastructure,
It's 100% deductible now.
yeah, and they get it immediately. I think that
So it's front-loading stimulus, basically.
that's what I expect it is.
And then delaying tax rises till after the election. Yeah.
So this is my worry, with the lifetime allowance, which is that, okay, they've set it to infinite, but if they don't make it back into power in 2025, which is looking possible, then, what's Labour going to do? I doubt they're going to let it stay. Because it's unbelievable.
This is the massive thing, isn't it, with long-term financial planning, which we don't often talk about because you can't really control it.
Yeah.
But the politicians can do whatever they want. And for all we optimize our ISAs and our pensions and the limits and shuffle into tax-advantaged investments, it can all just change overnight.
Yeah, I mean, it is a regulatory risk. And yeah.
But you want stability, right? For the good of the economy, ultimately, and for people to be confident, well, businesses to be confident for capital investment, and people to be confident to save for their future.
Yeah, I think
you achieve it.
This is what worries me, though. We're just going to flip flop back and forth between generous pension, and the state confiscating your assets. I don't know what's going to happen, but I think it would be very disruptive if Labour turns around and says, look, we're going to have a cap, or maybe even lowers the cap. You never know.
There's things they can do if they want to claw back tax without introducing a new low cap, as they could. Well, at the moment, pensions are so advantaged when it comes to inheritance tax, which is kind of not justifiable, right? They come outside the estate for some reason. Like, you can move it in.
It's just visible. Yeah.
Put it into the estate. It's just money like everything else, right?
Yeah.
That's one obvious one.
But we'll just have to see how it pans out. But it just strikes me that, when they make these changes and make out it's amazing, you just think, well, what's the next Muppet going to be in the Muppet Show, and what are they going to do?
Yeah, we don't often get political on your channel. On the podcast we do sometimes. I think we've gone over time. We're going to have to wrap up.
We have. Let's wrap it up. But yeah, anyway, look, thank you, Michael. That was awesome. Thank you very much.
No, I enjoyed it. We'll have to do it again sometime.
You were?
I was scared of doing the live thing. You've been trying to get me to do it for ages. And then I was like, it's the YouTube comments, man. You can't trust them.
Well, the one I loved from the last live stream was, thank you, Captain Obvious. You're just saying obvious stuff. So I thought, oh, great, thanks.
Yeah. Take it as a compliment.
But anyway, look, thank you all for joining us. I hope you enjoyed it. We did. So I hope you did.
Yeah.
If you did enjoy it, why not subscribe to the channel? We've got PensionCraft. Go to pensioncraft.com to find out about our membership, where you can learn about investing with other people. And we've got lots of members only content, and we also have Slack, so you can ask a question whenever you want. We've got the trackers, so you can track things like VIX, macro numbers, valuations, and lots of other goodies. And Michael's part of the community, so you can ask him questions.
I'll address one point. One of the readers on one of the comments says, Michael, you just said put pensions into the estate. You're talking about communism. No, I mean into the inheritance estate, so it just gets taxed as inheritance, not just the state takes all your pension if you die. Sorry.
Oh dear. Anyway,
I'm not a communist. Ramin's a Diet Coke socialist.
And on that bombshell, brilliant. Thank you everyone for joining us, and if you enjoyed this, we'll do it again. So please do like it, and then we'll know. Cheers.
Thank you, everyone.
Take care, everyone. Bye bye.